Hello. Today we are going to discuss on who has gained the most from the Iran war. The Middle East conflict has created pressure on households, businesses, and governments. Energy prices have risen, shipping has become more expensive, insurance premium have went up, and the financial market have become much more unstable. But for certain sectors, this same instability has become a business opportunity. The key winners are energy firms, defense contractors, freight and insurance company, Wall Street Bank, and the prediction market traders. Energy companies are often the first major winners during a Middle East conflict because the region is central to the global oil and gas supply. The Strait of Hormuz is especially important because around one-fifth of the world's oil and LNG normally passes through it. So when there is a threat to shipping in this narrow waterway, markets immediately fear the supply disruption. That fear can push the oil prices sharply higher. Brent crude is shown rising to a peak of around $126 a barrel before falling back later. For oil producers, high price can become a major cash flow windfall. Even if the production is disrupted, in some areas, companies that can keep exporting or use alternative routes can benefit from selling at a higher prices. That is why firms like Saudi Aramco, BP, Shell, and Total Energies are shown with strong quarterly profit. The main point is not that every energy company wins equally, but that companies with the right supply routes, trading operations, and market exposure can turn a crisis into higher earnings. The next major group of winners is the defense contractors. During the war, governments often rush to replenish their weapons, strengthen their air defense system, and expand their military stockpiles. That creates more demand for companies that make aircraft, missiles, drones, radar systems, and other military equipment. This slide highlights the companies such as Boeing, RTX, Northrop Grumman, and Lockheed Martin. These companies benefit from large government contracts and long order backlogs. A backlog means all orders are already placed but not yet delivered, so it gives the company the future revenue visibility. Between 2020 and 2025, private firms have received $2.4 trillion in Pentagon contracts, and a large share went to only a few major companies. So the conflict does not create a completely new business model, it strengthens an existing one where war and insecurity lead the governments to spend more on defense. This slide explains how shipping disruption can become profitable for freight and insurance companies. When the tankers cannot move normally through a major route like the Strait of Hormuz, voyages becomes longer, ships become scarcer, and the freight rate rises sharply. The slide shows tanker freight rates on the Middle East, Gulf to East Asia route rising from around 100 world scale points from the conflict to above 500 during the conflict. For a very large crude carrier, that can mean millions of dollars more per trip. Specialist tanker operators such as Frontline and DHT Holdings benefit directly because their earnings rise when the charter rates rise. Insurance is another winner. In risky waters, ships need war risk insurance. As the Gulf becomes much more dangerous, insurers were able to charge much higher premiums. A tanker worth $100 million could face around $1.5 million in insurance costs for a single Gulf voyage. So the same disruption that hurts the consumers and importers can create a very large gain for the shipping and the insurance firms. War also creates opportunity for Wall Street Bank because financial markets become much more volatile. When oil prices, currencies, bonds, and stock markets move sharply, investors react quickly. Some sell risky assets, some move money into safer assets, and others try to profit from short-term price swings. Banks benefit from this because they handle the trading. More market movement usually means more trading volume, more fees, and stronger revenue from the trading desk. The slide highlights the six largest US investment banks, which together earned nearly $48 billion in profit in the first quarter of 2026. The biggest gain came from the fixed income, currency, and commodities trading. In simple language, when the investors are nervous about oil, interest rate, or currency values, they trade more. And when they trade more, banks often earn more because there are more number of trades, and hence on the per trade they earn much more commissions. So if the volume of the trade increases, the revenue for these banks increases. So, while volatility creates uncertainty for ordinary investors and businesses, it can become a profit engine for major financial institutions. This slide focuses on prediction markets, where people bet on the real world events such as ceasefire, strikes, election, or policy decisions. In theory, these markets reflect the public expectation, but during war, they can also raise serious questions about information advantage and suspicious trading. The slide shows examples of unusually timed traders before major announcements. According to the sources text, there were large oil future trades shortly before a pause in the strikes were announced, and newly created accounts were made profitable bets on a US-Iran ceasefire shortly before it was publicly announced. So a pattern is seen that all the important announcements are made on Friday after the markets are closed, and very few people who know about the important decisions place the bets accordingly on Friday, and when the market opens on Monday, they earn a lot. The concern is simple. If some traders know important information before everyone else, they can make huge profit while the rest of the market is effectively playing blind. That is why this slide connects prediction market with the insider trading concerns, regulations, and market integrity. The bigger takeaway is that war creates not only volatility but also information gaps, and those gaps can be extremely profitable for a few number of people. So, to summarize, each sector benefits in a different way. Energy firms gain from higher oil and LNG prices, defense contractors gain from rising government orders and weapons replenishment, freight and insurance companies gain because the risky shipping routes make the transport and cover more expensive. Bank gains because the volatility increases the trading activity. Prediction market traders may gain from fast moving information around the major events. But the right side of the slide is the most important part. It reminds us that these profits come while the household, businesses, and the government face higher cost and uncertainty. So the message is not just about the corporate winners, it is about the unequal distribution of the war economic impact, pain for many, opportunity for a few. This slide shows how powerful the market sectors, the Wall Street banks, and the defense companies benefit from the uncertainty created by the Iran conflict. On the left side, we see the performance of the big six US banks: JP Morgan Chase, Bank of America, Citigroup, Morgan Stanley, Goldman Sachs, and Wells Fargo. On the right side, the slide shows the defense stocks. The companies like Honeywell, Lockheed Martin, Boeing, RTX, L3 Harris, and Northrop Grumman are included here. Even if not every stock rises equally, the overall defense sector remains attractive because the investors expect a long-term demand from the government. But these profits may not last forever. A lasting US-Iran deal or a stable ceasefire could reduce the energy prices, calm the markets, lower the trading volatility, lower the trading volumes, lower the insurance premium, and weaken this extraordinary profit opportunities. That is why the final message is clear. In times of war, the value is destroyed for many, but for some, uncertainty becomes a profit machine. Thank you.